Welcome to this deep dive into the world of key performance indicators, or KPIs, particularly focusing on those that play a crucial role in accounting and finance. Whether you're a business owner, an aspiring entrepreneur, or an investor, understanding these metrics can empower you to make informed decisions that impact your financial health and growth trajectory. So, let's embark on this journey together, exploring the essential KPIs that matter most in the realm of accounting and finance. To start, let's talk about what KPIs actually are. Think of them as the vital signs of your business. Just like a doctor checks your heart rate and blood pressure to assess your health, KPIs help you measure how well your business is performing. They provide insights into various aspects of your operation, from cash flow to profitability, helping you identify areas for improvement and growth opportunities. One of the first KPIs we need to discuss is the accounts receivable turnover. This metric tells you how efficiently your company collects payments from customers. To calculate it, you divide your net credit sales by your average accounts receivable. For instance, if your company had $500,000 in net credit sales and $100,000 in average accounts receivable, your turnover ratio would be 5. A high turnover indicates that you're collecting payments quickly, which is great for cash flow. But if the ratio is low, it might signal issues with your credit policies or collection processes, ultimately affecting your liquidity and profitability. Now, let's complement that with days sales outstanding, or DSO. This KPI gives you the average number of days it takes to collect receivables. If we take the same example of $100,000 in average accounts receivable and $500,000 in net credit sales, your DSO would be 73 days. A shorter DSO is a good sign. It means you're collecting payments swiftly, which enhances your cash flow. On the flip side, a longer DSO could indicate potential problems, perhaps in your credit policies or collection efforts. Shifting gears, let's talk about accounts payable turnover. This KPI measures how efficiently you pay your suppliers. To calculate it, divide your total purchases by your average accounts payable. If your company had $400,000 in purchases and an average accounts payable of $80,000, your turnover ratio would again be 5. A high turnover indicates prompt payments, which can foster better relationships with suppliers. However, if your turnover is excessively high, you might be missing out on leveraging credit terms that could benefit your cash flow. Next, we have days payable outstanding, or DPO. This metric tells you how many days, on average, it takes your company to pay its suppliers. If your average accounts payable is $60,000, and your total purchases are $300,000, your DPO would be 73 days. A longer DPO can be beneficial for cash flow, giving you more time to pay your bills. But be cautious, prolonged payment periods might strain vendor relationships and could lead to less favorable credit terms in the future. Now, let's discuss inventory turnover, which measures how effectively you manage your inventory. To calculate this, you divide your cost of goods sold by your average inventory. If your COGS is $400,000 and your average inventory is $80,000, your inventory turnover ratio would be 5. A high turnover suggests efficient inventory management, while a low turnover might indicate overstocking or slow-moving inventory, both of which can tie up capital and lead to losses. Complementing this is days inventory outstanding, or DIO. This KPI indicates how many days it takes to sell your entire inventory. Using the same figures, if your average inventory is $80,000 and your COGS is $400,000, your DIO would also be 73 days. A shorter DIO is ideal, as it signifies efficient sales and reduced carrying costs. However, a longer DIO might suggest excess inventory, which could increase storage costs and the risk of obsolescence. Let's move on to total asset turnover, which measures your ability to generate revenue relative to your total assets. To calculate this, divide your net sales by your average total assets. If your net sales are $1 million and your average total assets are $500,000, your total asset turnover would be 2. The higher turnover ratio indicates that you're effectively utilizing your assets to generate revenue, which is a positive sign for your operational efficiency. Next up is the operating cash flow ratio, which assesses your ability to cover short-term liabilities with your operating cash flow. To calculate this, divide your operating cash flow by your current liabilities. If your operating cash flow is $200,000 and your current liabilities are $100,000, your ratio would be 2. A ratio above 1 is a good indicator that you can comfortably meet your short-term obligations, while a ratio below 1 could raise red flags about your liquidity. Now, let's shift our focus to profitability metrics, starting with the gross profit margin. This KPI measures your ability to generate profit from your core business activities. To calculate it, subtract your cost of goods sold from your net sales, divide that by your net sales, and multiply by 100. If your net sales are $500,000 and your COGS is $250,000, your gross profit margin would be 50%. A higher margin means you're retaining more revenue after covering production costs, allowing for greater investment in growth and possibly dividends. Next, we have the net profit margin, which assesses your overall profitability. To calculate this, divide your net income by your net sales and multiply by 100. If your net income is $100,000 and your net sales are $500,000, your net profit margin would be 20%. This metric provides insights into how efficiently you manage expenses relative to your revenue. A higher net profit margin indicates effective cost management and can attract investors. Moving on to economic value added, or EVA, this powerful metric measures your ability to create value for shareholders. To calculate EVA, you take your EBIT, adjust for taxes, and subtract the cost of capital employed. If your EBIT is $500,000, your tax rate is 25%, and your total capital is $3 million with a weighted average cost of capital of 10%, your EVA would be $75,000. The positive EVA indicates that you're generating returns above your cost of capital, which is a great signal for investors. Earnings per share, or EPS, is another critical metric for assessing profitability on a per share basis. To calculate it, subtract preferred dividends from net income and divide by the weighted average shares outstanding. If your net income is $1 million and preferred dividends are $100,000 with 500,000 shares, your EPS would be $1.80. The higher EPS generally attracts investors looking for strong earnings potential. Let's not forget the price to earnings ratio, or PE ratio, which assesses the relationship between your stock price and EPS. If your stock trades at $30 and your EPS is $1.80, your PE ratio would be 16.67. This ratio helps investors gauge a company's relative value and growth prospects. A higher P/E ratio indicates high expectations for growth, but it could also mean the stock is overvalued. Now, let's discuss the debt-to-equity ratio, which measures your capital structure and financial leverage. To calculate this, divide your total debt by total equity. If your total debt is $1 million and total equity is $500,000, your ratio would be 2. A high debt-to-equity ratio indicates higher financial risk, while a lower ratio suggests a more conservative financial position. The current ratio is another crucial metric that determines your ability to fulfill short-term obligations. To calculate it, divide your current assets by current liabilities. If your current assets are $400,000 and current liabilities are $200,000, your current ratio would be 2, indicating a healthy liquidity position. For a more stringent measure, we have the quick ratio, or acid test ratio, which evaluates your ability to meet immediate obligations without relying on inventory. To calculate it, subtract inventory from current assets and then divide by current liabilities. If your current assets are $400,000, inventory is $100,000, and current liabilities are $200,000, your quick ratio would be 1.5. A ratio above 1 is generally considered healthy, indicating you can fulfill immediate obligations without relying on inventory sales. Now, let's delve into some advanced financial KPIs, starting with free cash flow, or FCF. This metric measures the cash generated from operations after accounting for capital expenditures. To calculate FCF, subtract capital expenditures from operating cash flow. If your operating cash flow is $500,000 and capital expenditures are $200,000, your FCF would be $300,000. Positive FCF indicates cash available for investments, debt repayment, or dividends. Next is the weighted average cost of capital, or WACC, which calculates the average cost of financing your operations based on debt and equity. To compute WACC, you take the proportion of equity and debt, their respective costs, and adjust for the tax rate. If your equity is $2 million, debt is $1 million, cost of equity is 10%, cost of debt is 5%, and tax rate is 30%, your WACC would be approximately 7.855%. This benchmark helps evaluate the profitability of potential investment projects. Return on equity, or ROE, evaluates profitability in relation to shareholders' equity. To calculate ROE, divide net income by average shareholders' equity. If your net income is $2 million and average equity is $10 million, your ROE would be 20%. A higher ROE suggests efficient profit generation, making it attractive to investors. The dividend payout ratio indicates the portion of earnings distributed as dividends. To calculate this, divide dividends by net income. If your dividends total $500,000 and net income is $1 million, your payout ratio would be 50%. A higher payout ratio indicates a focus on returning profits to shareholders, while a lower ratio suggests reinvestment in growth. Finally, we have return on assets, or ROA, which measures profitability relative to total assets. To calculate ROA, divide net income by average total assets. If your net income is $2 million and average total assets are $20 million, your ROA would be 10%. The higher ROA indicates effective asset utilization. Return on invested capital, or ROIC, assesses the ability to generate returns from capital invested in the business. To calculate ROIC, take EBIT after tax and divide it by total invested capital. If your EBIT is $3 million, tax rate is 30%, long-term debt is $2 million, equity is $5 million, and cash is $1 million, your ROIC would be 35%. A higher ROIC signifies attractive returns for investors. In conclusion, understanding these essential KPIs in accounting and finance is critical for assessing your company's financial health and making informed decisions. By evaluating liquidity, profitability, solvency, and efficiency, you can gain invaluable insights into your operations. As you navigate the complexities of financial decision making, remember that expert guidance is available. If you need personalized financial strategies tailored to your business needs, reach out to CFO Consultants LLC. We're here to help you optimize your resources and unlock growth opportunities. Thank you for joining me on this journey, and I hope you feel empowered to leverage these KPIs for your business success.